Welcome to the LiveSquawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary. Hello, and welcome to LiveSquawk's Market Talk on Wednesday. What's today's date? The 6th of February, 2026. This is a good start. I don't even know what day it is. For anyone new to the podcast, every week, myself and guests break down the key stories of the week just gone and look at the implications for the markets. We'll also preview the week ahead, providing you a heads up as to what you should be looking out for. At this episode, I'm joined by regular contributors and long-time, traders and analysts, Ryan Littlestone of Forex Analytics and Michael Brown, market analyst at Pepperstone UK, spread betting, CFD and Forex trading broker. Before I bring them in, just to a quick disclaimer here. The content provided on this channel is for informational and educational purposes only. We're not licensed financial advisors, and none of the information shared should be considered as financial investment or trading advice. Please conduct your own research, consider your own financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We're not responsible for any losses or gains that may result from following the content on this channel. I've written down topics of discussion, and my top topic is, when the hell will the rain stop? So, anyone who doesn't live in the UK, all we've had this week, and I know I'm talking with people who've had blizzards this week, so I understand, but I live in England, and here it's not stopped coming down. So that's my bugbear over and done with. Hello, guys. How are you both?
Oh, good, mate.
Michael and Ryan.
Yeah, very good afternoon to you, mate. Not too bad. I'll tell you what, it's a miracle because I've just looked out the window and there is the smallest glimmer of blue in the sky. So, you know, maybe the tide is turning a bit.
Well, I've just posted in our chat room. I'm cheesed off. Every time I look at my phone lock screen, it's got the weather warning from the Met Office on there, and it's been like that for 2 weeks, and I'm done with it. I was thinking about going to Spain for a quick weekend to remind myself what the sun looks like, but they've got worse storms than us, so I'm staying put.
Really?
Yeah, terrible idea.
Yeah. Anyway, well, it is brighter out there, so thank you, Mike, for that. That's brightened up.
And I mean, we're scraping the barrel when I'm the most positive out of the three. That says a lot about the sort of week that it's been, I think, doesn't it?
Well, according to Alex,
Lord
Wednesday, so we've got a couple more days to go.
Right. Again, just for the record, it's not Wednesday, it's Friday, for anyone who's but anyway, we'll carry on. It's been, talking of tumultuous times and that, again, we're going to focus a lot on the UK, I think, today, simply because the US data has been postponed due to this partial government shutdown. So we haven't had the non-farm payroll we were expecting. We did get some JOLTS data out, which we can have a quick review of, but generally the initial job list, I think it was. But for the most part, we're looking at the bulky data next week, and we'll come to that in the second half of this episode. But I want to start and kick off with the UK. Yesterday, we saw the Bank of England, MPC, the Monetary Policy Committee, vote by a narrow margin, a surprise narrow margin, to keep rates on hold at 3.75%. I say narrow, it was 5-4. When we were really looking at predictions, some were looking for, I think the majority were looking for 7.2, but there was a large minority looking for 6.3 voting pattern to hold rates. So the fact it was 5.4 was the first signal that we were going to get a slightly more dovish tone from the central bank. I think that's probably right to say. We'll start with Mike. What did you make of yesterday's interest rate decision?
Yeah, I mean, as you say, the vote split's certainly more dovish than expected. Only Governor Bailey changing his vote from December to this time vote for rates to remain unchanged. I think the way that I would be sort of framing the BOE is it's really just laying the groundwork or the foundations for a rate cut potentially as soon as the next meeting in March, because you had a bit of a triple whammy in terms of the dovishness. Not only that vote split, also the guidance was beefed up a little bit, and now explicitly saying bank rate is likely to be reduced further. They've sacked off this language around a gradual downwards path. And then the third sort of leg of that is the inflation forecast, which sees headline CPI getting to the 2% target in the spring, and then more importantly, either staying at that target or marginally undershooting that target through until the first quarter of 2029. So really quite a lot in there that signals quite strongly that the Bank of England are almost ready to cut rates again, and providing that the inflation data between now and the 19th of March behaves itself, I think they'll probably pull the trigger then.
Yeah, Ryan, your views from the trading perspective.
Yeah, it was a definite shift from the bank. Obviously, that hit the pound quite hard, as you would expect. I think they finally woken up. Cutting the inflation forecast for next year, by a huge amount from 2.5 to 1.7 shows them how worried potentially they are. And they don't mention it, but obviously what's going on in the UK, jobs and the government, and that impact on growth or lack of growth, as it might turn out to be. That's something we've been talking about on this show for a while now. Both me and Michael pretty bearish on the UK going forward. So they've done a bit of catching up, and dare I say it, they might be getting ahead of the curve on this, in terms of what happens with the economy later on. So yeah, we've had a reprice obviously in the quid. I think as we're going to talk about it, the focus is going to shift pretty quickly to the political mess. But moving forward, I think the risk now is that if their rate cuts don't help the economy, and the economy suffers, then they're probably going to see inflation going well below target, and they might have to keep going with their rate cuts past where they would maybe want to keep them somewhere around 3%. But that's for the months ahead.
Aren't you worried? And this is an open question. Are you worried that the fact that we're still seeing such a split committee, that this the path to further easing will be protracted? I mean, it's a 5-4 split. I mean, clearly there's not enough evidence, one way or the other. It would seem, at the moment, for the case to cut. I mean, or if you'd like that, for the reason not to cut next month from the hawks on the committee. Should there not be a bit more of a consensus than there currently is, based on what you said, Ryan? Mike, I'll let you come in first, then we come back to Ryan.
Yeah, I mean, to be honest, it is a really weird one, because if you go through and read the minutes, it's almost like the Hawks are looking at a completely different economy to the one that the Doves are looking at.
Yeah.
I mean, I find it baffling, to be completely honest. You've got people like Megan Green and Hugh Pill, who's actually speaking as we record this, still talking about the risks of inflation persistence and second round effects and all the rest of it. I would argue that those risks are very, very low at this moment in time. But the one thing I would say is we've spent, I think, all of us years, moaning about groupthink, whether it be at the BOE or other central banks. Well, the BOE hasn't had a unanimous decision since September of 2021. So at least they're having these discussions. We can argue around and debate who is on the right side of the coin. But actually, I think, arguably it is a good thing that they are having these conversations. And actually, some of those more hawkish members are showing signs that they might be starting to turn. I think it was Catherine Mann in her passage in the minutes actually flagged that she thinks the time for a rate cut could be approaching. And I did say semi-jokingly to Brian and his lot yesterday that it wouldn't be surprising when she does decide it's time to cut, she just votes for 100 basis point move or something, given how her policy views have been so volatile in the past.
That is a good fact and a good point about the consensus on the committee, and they haven't agreed. So yeah, I'll give them that. So as a trader, then Ryan, going into March or positioning from there, and this will link us into the next part of what we're going to talk about, which is the UK political maelstrom. What are you doing with sterling at the moment? How are you protecting yourself from the volatility, if you like, and from the newfound sort of weakness that we're seeing?
Yeah, well, just to do a bit of book talking. As you know from prior shows, I've been short the pound since last July. I actually got out the other day because, as I mentioned, I saw the UK economy maybe ending the year, coming into the early part of this year, doing a bit better. That would go against my euro sterling longs. So I actually exited out, and then got close to a level I was interested in getting back into, and then Starmer came out. But we'll talk about that in a moment. So I'm sort of a bit neutral. I'm still bearish, but one of the factors that caused me to stay short was the fact that the Bank of England was likely to be behind the curve. The economy would suffer in the early part of this year, end of Q1 into Q2, and then they'll be forced to rush in and play catch up. But now that's been removed because they have stepped forward. I'm a bit more neutral, and it's going to come down to the data. I think on the vote split, I actually think it's a sensible thing. As much as it surprises me to say so of the Bank of England.
Yeah, you think?
Well, outside of those, you've got. We know that inflation is always more sticky in the UK, and as much as it could come down, there's an element that where it might not, because we're seeing that elsewhere. We're seeing that stickiness in the States. We're seeing stickiness in Germany. Yes, there's a bit of differences between France, Germany, Italy, and the likes. We're seeing stickiness in Canada. We're seeing stickiness in Sweden, Australia. This is turning into be more than just one-off incidents where inflation is perhaps has found a bottom. And it's something I said way back when we were, in the inflation blip. It's not, but the problem's going to be, where does inflation settle back to? The Fed hasn't managed to get it back to target. The Bank of England isn't back to target. The ECB has just got it back to target, but all the others, they've all got there, and then it's moving up again. So I think it's right for the hawks to be hawkish, just as much as it's right for the doves to be dovish on the bank. And I think this 5-4 is something we might see going forward. Really will be the swing vote. If he thinks that we need a cut next month, then it'll be a 5-4 in favour of a cut. Then he can go 5-4 for a hold next time, then 5-4 for a cut. And they keep this middle line going for the foreseeable future, unless we get clear, defined data that moves some of the hawks across to vote for a cut.
You know what? I think that might be. Sorry, jump in, Harry. I think that might be the most important thing, is that, and actually almost why the vote split doesn't matter to markets, is because, as you say, you've got basically it's what does Bailey want to do? You've got four who are always, well, they've certainly voted for a cut the last 3 meetings in a row. You wouldn't imagine that's going to change. You've got 4 hawks who haven't voted for a cut since last summer. So it is just down to Andrew Bailey, which, kind of means that when the big man himself wants to deliver a rate cut, he's got the votes there to do it.
Yeah, exactly.
Well, you also likely have man alongside him as well, and at least for this near-term one, if there is one in March. Right, so let's factor in now the political situation in the UK. It's been a week's a long time in politics. Starmer's come back from the World Economic Forum. He's come back from China, thinking that was a success, and he's fallen straight into a new storm, really, with Labour Minister Lord Mandelson, Peter Mandelson. Is he still a Lord? Maybe he is, but I don't think people want him to be. And everything that he's tied up with. For those who living under a rock, Peter Mandelson, a stalwart Labour member, if you like, and an integral part of the Labour scene for the last 25 to 30 years, if not longer, was found to have had ties with Epstein, Jeffrey Epstein, the disgraced financier, and also has been alleged to have, I don't, alleged is the right word, there's evidence that he gave away secrets in 2008 while part of the Brown government, that potentially to a financier that he could have potentially profited on, and has had to step down as a peer, step down for the Labour Party. But it's now Starmer's, the current Prime Minister, Keir Starmer, and his decision-making process in appointing him as the US ambassador, and everything that goes around that, and how much did he know about his relationship with Epstein and so forth, and why would you appoint someone with those dubious ties? And so now we've got a situation where his position is even more under threat than it was before. and we're looking at potentially another disgraced minister in one respect. I was going to say Claire Rayner, but she was an old journalist. So Rayner and Wes Streeting, potentially Angela Rayner, that's it, and Wes Streeting, two more on the left side of the Labour Party, potentially usurping Keir Starmer and the current administration and running the country. We'll come to you first, Ryan, on this one. How would you unpick all this?
I think it's pretty easy. We've had two indications of how this could turn out. The first one was the other week when we had all that Burnham stuff kicking off and the market had a little wobble.
That's Andy Burnham, who currently is the mayor of Manchester, Greater Manchester, who is said to be a stalking horse for the leadership of the Labour Party and therefore potentially the PM. This was a storm that happened like a couple of weeks ago.
Yeah, and we got a little market wobble on that over, if he puts his hat into the ring with this by-election that happened. So we saw the pound get a knock and gilt's got a knock as well. The market had really been not really bothering about this Mandelson thing until it really kicked off Thursday. And then, we saw again the pound react, gilt react, and the market taking note that Starmer is in danger of being hoofed out of the party and from the PMship. So it is pretty clear because we've got different levels. You've got Andy Burnham, who's probably the more extreme to the left, thus the more market negative, because you chuck Torsten Bell into that as, him and his, I'll say, ambitions for chancellorship or that side of things. They're the most extreme. So if that picks up, you're going to see a big reaction in the pound and gilts. Then you've got, as you say, Rayner, who's probably a step up from Burnham, but a few steps down from Starmer towards the left. And then you've got Streeting's probably in between Rayner and Starmer. The market doesn't like uncertainty. That's the first thing, and that's what we're going to see the initial reaction on. Starmer, it's up in the air. Starmer could get through this period, but then all eyes are going to be on the May elections. And if he does badly, if Labour does badly in those, irrespective of how Reform does, then I think he's going to be on borrowed time. And that's probably the key time when we see, people putting their hands up to challenge him and him being on the cusp of getting booted out. So you never know in politics, he could be out the door next Tuesday if they decide that's where you want to push it. But otherwise, I think we'll see a can kick until May at least.
Well, it'd be a lot of it depends what the committee. There's a committee being charged now with finding out what the Prime Minister knew, what he didn't know, what senior officials within Number 10 Downing Street actually knew about the situation when it happened, and that could also bring up some more pressure on over the weekend or even into the next couple of weeks.
Mike, the process. Letters of no confidence going in, got to go through the 1922 stuff and all that palaver. So, we'll know if we get indications of that's happening.
Yeah, absolutely. Mike, just looking at this situation, but also the broader political scene around the UK, why would you invest in UK assets? It seems like we've been played with political ineptness now for a decade, if you like. Why would you invest in UK assets? And what does this do to the premium for UK assets at the moment?
Yeah, well, the short answer is you wouldn't. I mean, as you say, this is probably getting into year 10 of the political psychodrama now. Firstly, it was the Conservative Party, and now Labour have come in and decided to have a go at it themselves with this soap opera. For an international investor, it sends a pretty dismal message. That frankly, things are just a bit shambolic and a bit of a mess. And, when there's so many other competing investment options out there, you're naturally going to move your capital somewhere else. And I think we're starting to see that risk premium come back into the bond market. If you look at the spread on 10-year gilt yields over 10-year treasuries, that widened out to about 40 basis points earlier in the week, or yesterday, in fact, which is the widest point that it's been at this year, which is a clear sort of manifestation of that perceived increased risk around potentially Keir Starmer departing or being forced to depart, and a more left-wing successor coming in. I think in terms of that, my working assumption is still that he sort of somehow manages to muddle through until May after the local elections, simply because if you are a senior Labour MP who wants to become Prime Minister, why on earth would you want to do it and then have to own that terrible election result yourself? You'd much rather Starmer do that if you can. But it is a very fast-moving situation. So, there could be stuff in the weekend papers that changes that completely. The other thing that I think is perhaps going a little bit under the radar is, again, Starmer, Mandelson, Epstein, that's very much the focus at this moment in time. And the reason why it's significant is this is probably the first. We've had a lot of these sort of narratives and shambolic moments and U-turns since the government came to power almost 2 years ago, whether it's, business rates, winter fuel allowances, all of that sort of stuff. This is the first one, and probably the only one, where it's Starmer's own judgment that's being questioned, as opposed to that of officials or the Chancellor or whoever it may be, which makes this much more dangerous from a political perspective. But I think the other thing to bear in mind is we talk about, who might succeed Keir Starmer. Is it going to be Angela Rayner? Is it going to be Wes Streeting? None of these people have got a sort of clear path. Angela Rayner's got all of these issues regarding HMRC and tax that she may not have paid.
Just stepped down as deputy leader, didn't she?
It's exactly that. Andy Burnham's not an MP, and he's not going to be an MP anytime soon because he's been blocked from standing in that Gorton and Denton by-election. And then Wes Streeting was sort of, Peter Mandelson was almost his mentor at one stage.
Yeah.
Which is not exactly someone you want in your CV right now. So I think, it's an interesting one to see how all this pans out. There's a lot of moving parts, but I think the chances of Starmer going imminently are probably pretty low. The chances of him going after May were very high anyway. They're now even higher.
Yeah, good point. There's a note here I've got from HSBC. Emma Wilkes, UK economist, says the only certainty is uncertainty, which is a very sage sort of comment really on the situation at hand at the moment. I want to move on from that because I mean, it's not about talking down the UK economy. It's just these are the realities of where we're at the moment. I think for UK and UK assets, and it is what it is at the moment. You thought everyone was sort of pulling out of US assets. That was a blip compared to what we may well see here if things get any worse. We also yesterday had a rate decision from the ECB. We can gloss over this because again, it was one of those glazed eyes press conferences as well. Anything that caught your attention, Michael, from yesterday on the ECB front?
Not really. I mean, my doppelganger was present. Sadly, he didn't get a question this time, which was a bit of a shame. I guess the only sort of noteworthy remarks came when Lagarde was asked about the recent strengthening in the euro. And I thought it was interesting. She just kind of shrugged it off, basically saying that, we watch FX. Obviously, we don't target an FX rate, but that the euro has actually been rallying for about a year now, since last March. And the impact of that is already in the ECB's baseline scenario. So there have been some sort of chatter that a stronger euro maybe raises the chance that the ECB deliver a cut to try and tamp down on that strength a little bit. I guess you say that's now somewhat less likely, because Lagarde doesn't seem overly bothered about it. But besides that, there really wasn't anything of interest from the statement or the presser. And frankly, I don't think there's going to be for, well, maybe a year or so, barring some sort of shock. They're just on hold for the time being.
Well, I think the officials were doubling down on those comments about the euro and the fact that there's nothing new here in terms of the currency. What have you observed from the euro? And like you were talking about euro sterling and holding position in that for a period of time. Ryan, where are your views now on the euro?
I think we've got to watch volatility again. We've just seen 2 days being glued to 118, largely due to some fairly decent expiries there. It's this sell. We've had this sell America theme that's been in play, which I've not agreed with. It's not really a sell America. It might be more of let's just put our money elsewhere, keep what we've got in America and put money elsewhere. That's been behind the rally in the euro. That looks to have run out of puff a bit. You know, we've come into the new year. The data hasn't been great. You might have thought, you know, particularly from things like the PMIs, they've not gone overly backwards, but you would have thought they would have done a bit better coming into the new year, given a bit of positivity, particularly in Germany. You know, the flash number came in higher than last month, and the final number finished below it. So that was a bit of a knock. And they've got to try and flog this tepid growth, this 0.2s, 0.3s, 0.4s growth. You know, the Glad talked it up again yesterday, you know, resilient growth and, there's going to be investment coming and blah, blah, blah. No one's seeing it. So I think for the euro to continue going higher, it's either got to take something bad happening in the States regarding the data or Trump or whatever, or you've actually got to see a proper pickup in the economy across the board in Europe to get the euro moving again. So I'm pretty much neutral on it at the moment. You know, between 115 and 120.
Okay. There was a story from ING, really, and it's just an observation. They say German industry is still struggling to put better order books to work. Industrial production disappointed at the end of the year, but this was only a temporary halt, not a new downtrend. An industrial upswing is clearly in the making, they say. But again, how quickly that appears is still to be determined, I guess. Just quickly moving on to the flash Eurozone inflation reads, continued softening on that front. Still no concern over that on the disinflation front. You just think we're, do you guys both think we're looking around that sub target level for a few months yet? Mike?
Yeah, I do. And also that's what the ECB have projected in their forecasts anyway. You know, the majority of the disinflation that we're going to see in Q1 is going to be from energy and from base effects. You know, energy prices in January were down by 4.1% year on year. And I think if you look at how the data evolved last year, that impact will actually be exaggerated in February and in March. So we are going to see an undershoot of that target. Core inflation is still marginally above target. Services inflation is still just a smidgen above the 3% mark. So, you know, I think it's one of those where for the next 6 months or so, we probably need to just almost ignore the headline Eurozone inflation figures, because we are going to get probably down into the low 1%. They are going to be very, very noisy, and policymakers probably won't overreact to them.
Yeah, fair enough. RBA had an interest rate decision this week. They raised rates, but the messaging suggests we could see further rate rises to come, at least one more. Inflation necessitates more action, it would seem. Ryan, do you have much Aussie on your books?
No, but I don't mind having a dabble. I like a bit of Aussie Kiwi now and again. I've been trading that, excuse me, the last couple of weeks. Yeah, this was again a bit of a shift, but the market knew it was coming. Bullock is a very hawkish central banker at the best of times. We know that. Yes, they hiked, but even though she's hawkish, she still tried to keep things constrained regarding future hikes. And I think the biggest impact from this is how this might spread to other central banks, the RBNZ being one. Market getting a little bit hawkish over that until that jobs data earlier this week. So I think we're in one of those situations where the market is going to look at the RBA and other central banks, Bank of Canada, RBNZ, Riksbank and the like, and think, you know, is the next move going to be higher? And then if that's the case, is that going to spread to everyone else? So yeah, the RBA's led the way in this hike, and they may not be done, and we'll see what it leads to.
Okay, cool. We're going to move on to the week ahead then, and look at some of the key factors. We should have had non-farm payroll today. Obviously, that's now been postponed, and we're going to get it out next, I think, Tuesday or Wednesday. So, and then we'll also, in an unusual situation, now have Jan CPI, core CPI readings out as well. Can you trust? You know, we've gone into another partial shutdown. How much can you depend on US data at the moment to give you a clear reading of what's happening? We'll also get retail sales data as well due next week, so it's quite a packed week for US top tier data. Mike, how do you read all this at the moment, or is it just this? It was postponed by less than a week, so take it at face value.
Yeah, I mean, I think the jobs report is not going to be impacted at all. As you say, the shutdown was 2 days and all the data had been collected by that point
Yeah.
anyway. Having said that, the BLS employment report has other issues around falling survey response rates, and J-Powell reckons that NFP could be overstating jobs growth by 60,000 anyway. So, that there's a whole world of trouble around that data anyway. The CPI numbers, on the other hand, they are impacted by a shutdown, but it's the shutdown that we had last year in October and November, because, of course, for the October data, where the BLS didn't collect anything, they just assumed there was 0 price rises in the month for a number of categories. And the sort of knock-on effect of that is for probably 6 months or so from the November report, so up to March, April of this year, that is going to skew the headline and the core inflation numbers to the downside. So again, we can't really sort of overinterpret the numbers that we're going to get on that front.
Okay, cool. Ryan, just in terms of the dollar and how you position yourself around the data and so much, what do you do? I know you're not a short-term trader, so you're not going to react necessarily on this next week's information, but how do you position yourself?
Yeah, I mean, it's for the dollar, we're back to the data, which is going to be important aside from Trump and Iran and Russia and everything else, all the geopolitics going on. I don't tend to position for a data print. We'll actually look to react over them once I see the details. But we know that for the Fed, the data hasn't been too bad. Nothing's been falling off a cliff. Again, January non-farm payrolls can sometimes be a bit of a funny one, because you're coming out of that, busy holiday seasonal period, November and December. So that can skew things a little bit. The ADP obviously came in a little bit softer. So I think you've got to look at the variation. If it's a big variation, like a big negative or, a 3-digit positive, something like that, the market's going to move anywhere sort of within, I'd say 30k either side. The market's not going to be bothered. I think CPI is probably more important, because again, we saw a warm one in the last report, PCE, that we're still to get. Forecast to jump to 3%. That's going to put the pressure on the Fed, and obviously with Walsh coming in as well, everyone, particularly Trump, expected him to cut rates. How does he justify that if inflation's, going well above 3%? Retail sales, we know the consumer has been fairly strong, although we know that that's a top, 5% or whatever it is that's holding the rest up. So if that disappears, then that could be a big moment. So yeah, it's
really noisy on the whole, isn't it? In terms of having
Yeah.
non-farm CPI and retail sales out all in the same week, it's kind of a noisy picture, I
Yeah.
guess.
So I think for the dollar, we could, if the data holds up well enough, if non-farm isn't a disaster, if CPI is still sticky, if retail sales hold up, then I think we'd probably see the dollar gaining a bit of traction and undoing this sell America trade that we've seen in the last couple of weeks.
Fair play. We've talked extensively about the UK. We got flash GDP numbers out next week. We've talked about maybe it may hold up slightly better than initial thoughts, but I mean, I think there was a downgrade of 0.3% to. Am I right, or was that inflation? Yesterday from the monetary policy report for growth. We're looking at a flash read. I think I don't have a consensus, but we saw 0.1% on the previous quarter, and year over year was 1.3. HSBC is forecasting 0.2% for the quarter over quarter and 1.2 on the year over year number. Michael, just briefly on these figures, are you a bit more optimistic? We talked about this a little bit. A bit more optimistic about the UK economy just in the very near term.
Well, given that I was probably as pessimistic as it's possible to get, then me upgrading that stance is it's not saying a lot. But yeah, I think I am. Although I would say that the Q4 GDP numbers are going to be very, very noisy, because of course you had that Jaguar Land Rover shutdown in September, and then all of that production came back online in October and November. So a degree of the growth, as I think
it wasn't. Sorry, that was staggered. It wasn't. We expected more of it in October to come back, and
yes, you're right.
didn't happen, and it bled into November really.
Yeah, you're right. But compared to obviously the third quarter where there's no production at all, it will probably cause a little bit of a mechanical rebound. So yeah, I think, things are looking slightly less gloomy for the UK economy, but I still wouldn't be sounding the all clear.
Enough. Just a quick note before we finish up today. Now, mainland China Jan CPI data will get over next week as well, and we'll get Japan Q4 GDP. Obviously, we've got elections in Japan to contend with as well. So, I mean, that may bolster Takaichi's popularity. I think it do very little in terms of the ballot box. I think in the near term anyway. But things to watch for next week. We're at the end now. We've run over a little bit, but I'd like to thank you. Oh, just one last thing. This on the geopolitical front, we've got Iran, obviously, US-Iran talks. Do either of you have any hope that we could see something out of that, or is it just another merry-go-round for these talks again? We seem to be here every so often, and it's. I mean, how impactful is it for the market?
I think it could be impactful this weekend. Either we're going to get a solution, or there's a prospect of Trump letting loose his navy that's over there. I don't think Iran wants that, so I think there's a good chance they get a deal done in some
What, a
way, shape,
meaningful
or
deal?
form. Probably not. It's probably enough to get them through the next few months until they have to do it all over again. But it has to be done. Iran knows what will happen if they don't get a deal done. They've had this I won't call it a revolution, but biggest protest on over there for a long while. So if they end up getting attacked by the US, that's going to kick off even more. So I think it's in their best interest at this juncture to calm things down by getting some sort of deal done.
Sorry, Mike, anything to add?
No, I think he's pretty much spot on there. Obviously, we hope that some sort of agreement is reached. I think it's certainly in Iran's interest for it to do so. But yeah, it's very much a weekend where if I was trading, I certainly wouldn't want to be short crude going into it, given the potential gapping risk on an escalation, or even in the other direction if we were to see a deal get done. So I wouldn't be surprised to see traders squaring up their positions as we move into the weekend.
Fair enough. Listen, guys, thank you very much, both of you, for your comments today and your words on what's been, I reckon, volatile. We haven't even gone into the market moves on the equity side of things, because and also Bitcoin. We haven't had time to get into Bitcoin. Maybe we'll do another session on that. But it's been an interesting week for trading, and I suspect February is going to be one of those sort of months where we'll get all sorts and everything over the course of the rest of this month as well. So for short-term traders, I'm suspecting there's sort of opportunities out there, and maybe even for some mid to long-term investors as well. So yes, thank you both for coming on today's episode. Thank you.
Pleasure, mate.
No, thanks for having us, mate.
Anyone who missed the start of this episode can go back on the socials or to the podcast platforms and listen back at your leisure. This will go up on all those sites, and we'll get you guys on again soon. For everyone else, have a lovely weekend, and keep an eye on the news for any developments in the Middle East with US-Iran chatter. So, but thank you all for listening, and we'll see you again in the very, very near future. Thanks for tuning into the LiveSquawk podcast. Your edge in the market starts here. Subscribe now.